Good morning, everyone. I'm T3 Live Editor-in-Chief John Darsie.
And I'm Brittany Umar, and together we bring you Morning Call. Our futures are pointing to a sharply lower open this morning as the debt ceiling deadline of this Thursday, October 17th, draws even closer. So at this point, John, being as it is so close, what is the likelihood that you think will default?
I don't think we will default. I really don't. I think there's enough sensible people in Congress on both sides of the aisle that realize that a default would be a huge disaster. And I don't think that, especially around the world, everyone's sort of looking at us from afar right now like, are these guys crazy? What are they doing thinking about a default could plunge the world into recession, would hurt our credit rating, would be an absolute disaster. And I think people understand that we should never resort to that tactic, but leave it up to these guys in Washington to leave everything to the last minute with the fiscal cliff. With the last debt ceiling negotiation, we went to the last minute. None of these guys are going to give an inch until the last minute to try to get everything they want. And we should have maybe known a little bit better last week when it seemed like they might iron out a deal over the weekend. That's just not how these guys roll. As my father told me growing up, don't count the chickens before they hatch, especially with this group we have in Washington. So, yes, I do think we'll get it done, but anxiety will continue to grow until that Thursday deadline. There are more voices. There are some, prominent voices out there that think we could default. I don't think it's going to happen, but that doesn't mean you trade based off of a coin flip.
Right. They like to stress us out, don't
they?
Yep,
absolutely.
Well, so in the meantime, all we can do is focus on the charts. So what are the levels that we should watch in the S&P?
Yeah, price action is king, but while we follow the price action, you also have to keep in mind that we are in a headline-driven environment. So you adjust your aggression levels based on how much headlines are driving the action. But taking a look at the chart, watching the price action last week, we closed with 2 strong days of price action to take us, back above. We enveloped a couple weeks of downward type movement, a really strong move. But then, as we said, futures are about 10 handles lower on the S&P this morning, not taking us below Friday's low, but we'll probably flirt with that level today. And the 8 and 21-day moving averages also right in that area. A cluster of support here from back in late September, early October, also in that area. So, that 169 level on the S&P will be on the spiders will be an important level to watch, an important battleground for short-term composure. But given the fact that it is Columbus Day, bond markets are closed. Yes, obviously the stock market is open. I think we could get some choppy sideways type action, as expectations are generally that we will raise the debt ceiling, but the deal's not done yet. Who knows what could happen in Washington until that point to potentially throw a wrench in all this stuff. So I think people are sort of going to be in wait-and-see mode. They're not going to be dumping their stock, but they're not going to be piling in new stock either. And I think that could lead to some choppy sideways type action.
And meanwhile, there are always resources that you can turn to, resources like the Off the Charts newsletter, which I understand recently got a facelift. Can you tell us about that?
Yeah, starting today, we sent out a few emails to our community about this, but starting today, our Off the Charts newsletter, which is our signature trade ideas newsletter, which every night comes out at 8 p.m. Monday through Thursday. We've added a night to that, so now it's going to be Sunday through Thursday. We're going to come out with a weekend edition to get you started with a plan every Monday, and we're also going to be keeping a more formal watch list of all the ideas that we talk about in Off the Charts. So at the beginning of every newsletter, in addition to annotated charts and commentary, there's going to be a table with all of our open trade ideas, so you can keep track of any trade idea that hasn't either hit its target or hit its stop. So you can have a wide list of ideas that we've proposed or shared, highlighted over the last few weeks. So a couple great additions there. And in addition, we're also going to be focusing even more on the price action, on the patterns, give you some stocks that maybe you haven't heard of before rather than just focusing on high beta tech and the very prominent names in the market. So some really great changes going on with the Off the Charts newsletter. Still going to be the same price, $29.99 a month, $1 a day. I think that could potentially pay for itself, in one trade, obviously. So definitely, if you haven't taken a trial to Off the Charts yet, or you were on Off the Charts before, I would say revisit it or take a try now and see what you think about it. I think it could really add some value to your trading.
Agreed. I think so too. All right. Well, we've been so busy talking about the government shutdown and the debt ceiling that we haven't been focusing as much on earnings. But earnings season is really heating up. The banks continue to be in focus this week after JP Morgan and Wells Fargo reported on Friday. And some would say that was a pretty rocky start to bank earnings. We have Citigroup and Bank of America tomorrow. What are you expecting from the banks this week?
Yeah, we talked about this in the Express, but when you have a macro event like the debt ceiling, it overshadows sort of everything else that's going on. I think a lot of people have just forgotten about the whole Syria situation. You talk about Syria, say, what happened in Syria? I don't know. And you talk about earnings season. It's overshadowed the fact that we are entering earnings season, which is typically a big market-moving part of the year, obviously. And we had those bank earnings on Friday. We'll take a look at the chart of J.P. Morgan. And we sort of had opposite situations with Wells Fargo and J.P. Morgan on Friday with those reports. As J.P. Morgan reported an absolutely terrible report, but that was sort of priced in. It was due to those legal write-downs with the government settlement and all the legal costs that have gone into that. It actually opened higher despite a quarterly loss, but then traded back down near the flat line. So at the end of the day, it didn't go anywhere. But then you look at Wells Fargo, it had a different path to travel to get to the flat line. It opened sharply lower after falling short of expectations, but then traded back up to near the flat line with a real big green bar during the day. So different paths to get to the flat line. The Wells Fargo path a little bit more bullish considering there was actual buying interest during the session. So just something to keep an eye on there. Like Brittany said, sort of a rocky start to earnings season for the banks. And then we have Citigroup and Bank of America on Tuesday. No real edge there. I think people not really expecting anything great, so maybe a strong report could boost those, but I don't think people are really expecting much out of the banks.
You want to show us the XLF then, just to show us the group?
Yeah, we'll take a look at the chart of the XLF as we check the temperature of the sectors as we do every Monday. The XLF, obviously, with the market the last 2 trading days, has seen really impressive price action and taking us back up into this gap that we have that opened on September 23rd. That'll be the short-term level to watch, but we are opening lower in the market this morning, so it'll be interesting to see. These moving averages are now supporting the stock. Those will be key levels to see if we hold, and then you could talk about Thursday's high and then Friday's low. If you're a short-term trader, those are levels for you to potentially gauge composure and measure your trades against. So it's an area that is going to be very beholden to earnings starting on Tuesday and then Thursday with Goldman Sachs. So if you are going to be trading these and you're trading the equity, I wouldn't be holding them overnight. I would be trading them during the session, maybe after the reports if you're trading the individual names, even if the XLF. If you're going to be trading the XLF, I think you also take sort of an intraday approach and wait till earnings come out for the group before you start trying to swing trade.
All right, well, let's continue to check the temperature of the sectors and take a look at the consumer staples, which led the market up on Thursday and then had nice follow-through on Friday. So this could be a group to watch today for continuation.
Yeah, consumer staples are one of those defensive sectors that got a boost with the flight to safety that we've seen in the market over the past couple weeks, as people have realized that a default is actually, even if it's a distinct possibility, it is a possibility. So investors have been fleeing a little bit from riskier assets like tech into those safety defensive type sectors. Take a look at the XLP. As you can see, with the market, 2 impressive days of price action. Really impressive day on Thursday. Obviously, like a lot of the rest of the market, took it back above the 8 and 21-day moving average, back above the 100-day moving average. The 50-day is still serving as resistance. It wasn't as strong on Friday as some other pockets of the market, so that could be a telltale sign that this is just a transitory type bounce, that when we do raise the debt ceiling, even though it will probably be a short-term raise, that some of this price action could be retraced. So definitely keep an eye on the 21-day moving average here. That could be a key level that comes into play if we do get some more downside leading into the debt ceiling deadline on Thursday.
And the utilities were actually able to join the market rally last week and reclaim all key moving averages. Do you think we could see this group really come back more into play? The
utilities is even more traditional defensive sector, high dividend yield, not a ton of price appreciation potential traditionally, even though this year the utilities are a sector that was absolutely blockbuster for most of the year until the taper talk started. If we take a look at the chart of the XLU, it was even strong before the market bounce, because amid all that market turmoil, you saw tech get hammered last Tuesday, and then you saw utilities actually close significantly higher on that day. So that was just a stark example of a flight to safety type situation. And it did get some topping tails on Tuesday and Wednesday, or just some tails that were a sign that maybe it doesn't want to go higher, it isn't ready. But you saw with the market perking up, you saw the utilities join in that rally. So it's good to see utilities perform well in all environments. It performed well in market turmoil. The XLU performed well when the market was strong. So encouraging signs there, and maybe people are just getting fed up with all this back and forth, short term, kicking the can down the road type stuff in Washington, and they say, you know what, I'm just going to put my money in a 3-4% dividend yield utility stock, let my money grow over time, and just be done with all this nonsense that's going on in Washington.
Well, it's also encouraging to see the Russell doing well. The Russell was able to soar all the way back to highs and gain almost 1.5% on Friday. And this is a group that we often look to for clues about market direction.
Yeah, and it's also a sector that you look to for clues about risk appetite. You talk about the potential flight to safety in the defensive sectors. The action in the IWM would sort of tell you the opposite story. We did see tech get really hammered last Tuesday, and the IWM did as well. But to see this type of rally back to highs in the IWM is also a sign of healthy risk appetite and healthy speculative type attitude in the market. When you have small cap stocks, which are typically considered more risky, performing better than any other group, that's obviously an encouraging sign. And you take a look, we'll zoom out to the weekly chart there as you see the IWM back at highs. You know, we're getting ready to make another new all-time high in the IWM. So that's obviously really encouraging, like I said. Just something to keep an eye on. So if there's some small cap stocks that are on your radar that you like, maybe those are the best ones right now, the setups that you should focus on. So impressive action there.
All right, coming up, we're going to go in the trenches with gold and silver. But first, a quick commercial break. We'll be right back.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
We're back and going in the trenches with the metals, which have been tumbling, kind of demonstrating that investors might be actually gaining some confidence within the market. We had gold dropping about 1.3% on Friday. So what are you thinking about gold heading into today?
I mean, gold obviously had a big bull run for several years there, but now it's in a very firm downtrend on multiple time frames, and it's one that I'm very bearish on all those time frames. This morning, actually, gold is perking up a little bit, erasing some of those losses from Friday, but in general, I think this is a type of situation where you short bounces unless you think we're going to default and the world's going to implode and we're going to dip back into recession and QE is going to have to increase and all that type of stuff, which I think is very far-fetched at this point. But last Tuesday, we saw gold actually finish lower despite all that market turmoil that we saw. But take a look at the chart of the GLD. This is the day right here when the NASDAQ finished down 2%. You saw tech stocks down 7-8% in one day. Gold still couldn't go higher, and that was the big red flag, is that when the market's in turmoil, that's often a time that gold performs well. And the fact that it finished lower on that day was a telltale sign. And what do you know? We get 3 days of really downward price action to take us below that pivot low. This morning, I'll take a look at the 5-minute, 24-hour. We're set to open back up above 124. So we go back and look at the daily chart. The low from Thursday is 124.10. So that's where we're basically closing that gap from Friday. So that'll be very important to see whether we can hold those gains or, like last Tuesday, whether or not during the session traders fade that gap up in gold. Take a look at the weekly chart. As you can see, the big pivot is the one down from June, down around 114, 115. If we do get down to that level, and if we break that level, it's look out below for gold. As obviously, there's not much in the way of support until you get down into the $85, $90 area for GLD. I guess you could say there's a pocket there at 100, but overall a very bearish asset right now.
And I would imagine a very similar case then for silver, which lost 1.5% on Friday.
Yeah, silver, similar situation. Sometimes they move a little bit different than each other, and you never really know why. But silver, if you take a look at the chart, not much to say here that I didn't say for gold. Some people say, oh, silver has some industrial applications, and that makes it potentially more valuable. I think silver's not priced because of the industrial applications of the metal. It's priced for speculation and potential inflation hedge, just the way gold is. But obviously you got the pivot down here, this little island low that's around the $20 area. So we're gapping up this morning, could fill most of this gap, but I still think this is one that you look to short bounces on gold and silver.
All right, time for some quick hits. Let's check in on Apple, which held up well last week, continued to find support at the 21-day.
Apple's one that in weak environments it's been holding up well, and then in strong environments it's been sort of lethargic and unable to break higher out of this descending trend line, this wedge pattern that's been in place. You take a look at the chart. As you can see, though, Friday, a really nice day of action after it was lethargic during the session on Thursday during that big market rally. And then with the futures up, we'll see where it is Take a look at the 5-minute this morning. It's actually trading around 488 this morning. Take a look at the daily chart. It's actually down a few bucks with the market up, so continues that theme of being choppy despite the market being up. Apple's lower, sort of in keeping with the action we've seen recently, but continue to keep an eye on this downward trend line and this wedge pattern that's in place. If we do break lower out of this wedge, if we break down below this uptrend that's been in place since September 16th, 17th, then we actually could get some downside action. That's the great thing about wedge patterns, is that you can be neutral on the trade and just enter based on whether or not it breaks higher or lower when it gets to the apex of that pattern.
All right. Well, and casinos have been acting well, especially Las Vegas Sands, which broke out to new highs on Friday. Would you expect some continuation there today?
Yeah, really strong action in the casinos, like you said. Take a look at the chart of LVS. That's the best way to talk about it. Held the 21-day moving average amid the market turmoil, so it could have been one of those ones that you put on a list, a shopping list of ones that held up relatively well amid the turmoil. And then the next 3 days, and then Friday obviously was the impressive breakout day in LVS. Quickly, I'll take a look at Win and MGM. Win even stronger. MGM, that's the one that hasn't gone yet, so maybe some people think this one could play catch up a little bit. I would be wary of those. I like to play the ones that are actually leading the way, so if we do get sideways action, Win, LVS, those would be the ones that I would be a little bit more encouraged to trade.
And Elon Musk's Solar City soared 23% on Friday when it boosted its outlook for next year. Should we be looking at other solar stocks now?
Yeah, Solar City, obviously 23% monster jump. Could bring some attention to the other solar names that even a lot of these small caps solar names have been strong even prior to this big jump in Solar City. But take a look at the chart of Solar City. What we say about these big igniting type moves is that they generally lead to more upside. You don't see these big types of moves get erased quickly, and if they do, it's a huge red flag for the stock. But this is a huge disruptive gap and go to the upside. Take a look at the weekly chart. Takes it back above this pivot from the summer, and I think this one, given the size of this igniting move, I think you could see Solar City back at highs. I guess with Tesla sort of taking a little bit of a dip last week, Elon Musk has got to pick up the slack somewhere, and he's devoted a little bit more attention to Solar City.
How about Schlumberger building a tight upper range? Looks like it could break out at what level?
So you got SLB here. Just go ahead and take a look at the chart. As you can see, it did close below its 21-day on that Wednesday after the carnage in the market. It was not able to reverse like some other stocks, but then obviously really impressive action in the market on Thursday, and Schlumberger was one of the best performers there as it gapped up to reclaim all those losses from the previous day and then reclaim the losses from Tuesday during the session. So really impressive action there. And then the pivot high here that it could potentially break above to add some momentum is 90.47. So just a few cents. We'll take a look at the 24-hour to see where Schlumberger is this morning. No real prints, no real indication so far on our charts here, but just a few cents away, less than 50 cents away from the breakout in SLB. Keep an eye on that pivot high.
And Applied Materials, tight consolidation range there. What are the levels to watch?
AMAT, wonderful looking pattern, sort of our bread and butter type pattern that we talk about in our active trading course. You like to see a gap up, you'd like to see the gap hold, and you like to see the stock consolidate, form a nice upper level base above the moving averages to allow the moving averages to play catch up, and then a potential break above that range. So we have AMAT closed at $18 right at the top of that range on Friday. Not sure we'll get any indication so far this morning. Looks like it might be up a little bit, but this is one that I think could definitely get some more momentum above this upper level base.
All right, looks beautiful. So what do you think heading into the first trading session of the week and everything that we have going on here headline-wise?
I think what you try to do in these types of environments is, I think the indices are going to be choppy. Like I said, I think most people expect a deal to get done to avoid default, but it's not done yet. Washington is a circus. Who knows what could go on there? So I think most people are going to be just sort of standing pat right now until that deal gets finalized. So I think if you're going to trade stocks, be very stock selective and focus on stocks that aren't as correlated to the market. Stocks with low correlation, stocks like an AMAT, stocks that don't necessarily react so much to big market moves. Even something like Apple right now has sort of not been moving with the market. So the pattern looks decent there. It's just one example. So definitely be very specific, stock specific if you're going to be trading right now. The indices, I don't think you have much edge.
All right, that's your morning call for this Monday. Happy trading. Have a great day.